Great. We are now live. I'll just quickly make you the host, Vivek.
Okay, I have shared my screen now.
Yes, it's visible. We're all set up. So, hey everyone, good evening. Hope you all are doing well. Thank you for taking out the time to join us for our monthly Rebalance AMA webinar. It's always great to see all of you tuning in every month with us. My name is Simran, and I'm from the marketing and business development team at Gulaq, and I'll be your host for today's session. We also have with us Mr. Vivek Sharma, our key speaker. Many of you probably already know him, but for those who don't, he is the investments head at Gulaq and brings in years of experience in the markets. Welcome, Vivek.
Thank you, Simran. Welcome, everyone.
You must be wondering what's stored in today's session. So, like every month, we will walk you through the latest portfolio rebalance and how our strategies have been performing. I know a lot of you must be wondering right now, should I be worried about what's happening in the markets? Should I be making changes to my portfolio? Well, these are completely all valid concerns. With all the noise that we have been hearing around the US tariffs and market volatility, it's only natural to feel a little uncertain, but that's exactly why we have these sessions to help cut through the noise and give you a clear, data driven perspective on whether things stand where and what it means for your investments. This session also gives us a chance to connect with all our investors directly, answer any questions that you may have, and also receive any feedback that you may have for us. Some of you have already sent in your questions through the Google form, which, by the way, thank you so much for that. But for the people who did not get a chance to send in the questions, we'll also have a live Q&A towards the end. So if there's any questions on your mind, just drop it in the chat and we'll try to address these towards the end. Before we get into the rebalance update, let me also quickly introduce you to who we are and what we do for the people who are joining us for the very first time. So, moving on to the first slide, at ST, we have been all about systematic, data driven investing for over 15 years now. Our approach is powered by research and technology. So, instead of making emotional decisions, we rely on rules based strategy to invest. We started back in 2008 when SEBI allowed algo trading in India, and today we are managing an AUM of over 1500 crores. ST primarily offers portfolio management services for high net worth individuals, but we wanted to make systematic investing accessible to everyone and not just the HNIs. That's why we launched Gulaq, a retail investing solution built on the same methodology as our PMS portfolios, but without the high capital requirement. So it's built on the same principles, the same ideologies, but you get to start with a lower ticket size. Over the last 4 years, more than 25,000 investors have used our model portfolios on small case and pick right to make data driven investment decisions. Moving on to the next slide, let me also quickly introduce you to our team. Sandeep Tyagi, our CEO and chairman, is the brain behind Gulaq and ST. He is an IIT Delhi and Columbia Business School graduate with 3 decades of experience in analytics and finance. Vivek Sharma over here, our head of investments, has a BTech and MTech from IIT Kharagpur and over 20 years of experience in the investing world. Whereas me, I work in the business development and marketing team as an assistant manager. I've done my bachelor's from Miranda House in Economics Honors and have been part of ST Group for 3 years now. With the entire team at ST, our mission is quite simple, helping investors make informed, data backed investment decisions. Before we jump in, moving on to the next slide, these are just some quick compliance notes that we wanted to inform you about. As a SEBI registered investment advisor, we are required to remind you that all investments come with some risk. Please read all relevant documents before you make any decisions. Also, any securities we may mention today are just for informational purposes and shall not be treated as recommendations. You can see our SEBI registration details and official address on your screen. So feel free to pause here if you want to glance over these points quickly. All right, with that out of the way, let's get into it. Vivek, over to you to walk us through the latest rebalance and how things have been shaping up at Gulaq.
Thank you, Simran. So I'll quickly take everyone through the performance of our portfolios. First of all, the market cap based portfolios, the three portfolios that we launched in December, the large cap, mid cap, and small cap, and then over to the gear based portfolios. And then we'll move on to your questions. So large cap overall markets recovered pretty well last month. Large cap gave about 7%. Our portfolio moved in line. Overall, we have some decent underperformance since the time we launched. But if you can see the expected performance, our backtest results give us some indication as to what is to be expected from these portfolios, right? Now, mid cap again, since inception, we are kind of break even, slight underperformance, but last month was pretty good, and we were able to recover huge losses that we had initially in mid cap stocks. And similarly with the small cap stocks, since our inception, we are down about 2.5%. So about in last 4 months, we are down about 2.5%. And overall, last month, we were in line with overall Nifty small cap 250 index. Right. Moving on to our gear-based portfolios, we have these gear-based portfolios, gear 3, 4, 5, 6. Gear 5 and 6 have high equity allocation, so they are meant for more aggressive investors. For more moderate risk profile investors, we have gear 4 and 5. And for conservative to moderate investors, we have gear 3. As you can see, as we are moving down from gear 6 to gear 3, the allocation to equity is moving down and the allocation to debt is increasing. How this impacts is overall your risk goes down as you are moving down uh, from gear 6 to gear 3, but your returns also come down. So gear 4 actually is my personal favorite because the 60-40 portfolio is one of the most popular portfolios world over, which has 60% equity, 40% debt. It performs fairly well in typically all market conditions, be it bull markets or bear markets. And we'll have a look at the overall performance of all the gear-based portfolios. So this is how our gear 6 looks. We have in April this month, we have about 37% allocation to large caps, about 41 to mid caps, and to small caps, we have about 22%. This is pretty much in line with what we had in March. Some small changes, but otherwise pretty much in line. In terms of our sector-based allocation, our allocation to healthcare has increased quite a lot from 11%. So we were earlier also quite bullish on healthcare, and now this has now increased to about 25% of our portfolio in healthcare stocks. So overall, BSC 500 has only about 6% allocation to healthcare. So we're quite bullish on this. Financials, we have been uh, really not so bullish. We have been underweight. So BSC 500, as you can see, has 31% allocation to financials, whereas we have just about 16. So roughly half of what's there in BSC 500. Another top two are consumer discretionary industrials, which has 11%. So we are underweight on consumer discretionary and slightly overweight on industrials. And finally, consumer staples. That's another sector where we are hugely bullish. So overall, 7% allocation in BSC 500 to consumer staples, whereas we have about 30% allocation. So this is how our portfolio looks in April. Now, looking at the factor-wise weight, uh, as you can see in, I think it's pretty much in line with last month, with volatility, momentum, quality getting 0% allocation, whereas most of the allocation is towards the value stocks, which wherein we identify the undervalued stocks and about 30% to leverage, which is pretty much in line with March. So I think one of the questions somebody wrote that why have allocation to momentum, but Just about Feb, we had some allocation. Otherwise, March, April, we do not have any allocation to momentum stocks, which typically tends to be much more volatile. So when the market goes up, momentum stocks go up at a much faster pace. And when the market comes down, momentum stocks are the ones that tend to fall the highest. This is how our returns look for Gulaq Gear 6. So we do have some underperformance over last 1 year. Whereas if you look at longer term performance or performance since inception, which is May 2020, we have a pretty healthy outperformance. Yeah, but in short term, in last 1 year, we do have some underperformance in Gear 6. Gears 5 again, the difference, as I told you earlier, the difference between all of these geared portfolios is only in terms of asset allocation, whereas the equity allocation, the allocation to stocks remains the same. So you'll have same stocks in Gear 5 in any gear-based portfolio, just the allocation to that part would be different. So here again, we have some underperformance in last 1 year, whereas over longer term, we have produced decent outperformance. Yeah. Again, this is Gear 4. As you can see, I was telling you over last 2 years, in spite of the correction and in spite of the underperformance in last 1 year, over last 2 years, we have actually performed pretty healthy alpha of 8.7%, with much lower volatility, because this has about 40% debt. These portfolios are much lesser volatile as compared to our Gear 6 or equity only portfolios. So you can see in last 1 year, this specific portfolio is still positive 2.2%, whereas if you see our Gear 6 portfolio is down slightly at 2.4%. And this is finally Gear 3, which is for the most conservative investors, which just has 40% equity and 60% to debt. And here also, if you see, our last 1 year returns have been positive 4.1%. And overall also, if you see the excess returns, we have been doing pretty fine over long run. Yeah, so this, just to recap all the gear-based portfolios, last 1 year, if you see, our Gear 3 and Gear 4 are positive, whereas Gear 5 and 6, which have higher allocation to equity, they are the ones who are negative. But overall, over longer term, we have produced alpha in all of these four portfolios. Okay, this is how our Gear 6 performance look over past 6 years. So we launched in May 2020. So next month we'll be finishing 5 years. And if you look at this, for the first 4 years, we produced pretty healthy alpha. So first year, our alpha, which is the difference or the outperformance from index, was about 22%. In the second year, it was about 23%. Third year, it was 18%. And then fourth year, it was 25 and 12, roughly about 37%. No, 25 and 17. So 42% alpha in calendar year 23. Last year, it was break even, roughly around same, 15%, whereas this year we have underperformed. So a negative alpha of about 5.5% this year, calendar year. But overall, I think this is a part and parcel of investing in active funds, where at times you will tend to underperform the index. No matter the strategy, be it quant, be it discretionary, be it whatever style of investing, whether it's quality or value or momentum, any active fund underperforms from time to time. But over long run, the good ones will actually be able to generate decent alpha for you. That's how it is. Okay. So now we actually get quite a lot of questions regarding market corrections. I personally talk to a lot of investors, and they are really concerned, and they have questions like, should I stop my SIP investment? Should I redeem? what should they do in this? So, and many questions are around SIP also. So, should they stop SIP? And we have seen this data also in the mutual fund SIPs, where I think from February onwards, there have been a dip in overall number of SIPs that are ongoing in mutual funds. And this happens in every down market, every correction, that people are really fearful about what is to be expected. There's a lot of negative news, be it on social media, be it on news channels, lot of negativity flowing around. So investors are usually very concerned, and this is the time they make a lot of mistakes, right? So I thought maybe I'll just share my views on how one should go about investing. And primarily, see, this is whatever I'm sharing, it's meant much more for longer term investors. If you are investing in equity markets for a shorter time frame of 1 to 2 years, ideally you should not be investing. If you have a time frame of just 1 to 2 years, in that case, the ideal investment should be in debt markets and not in equity markets, right? So if you look at the historical data, this is the Sensex data since January 91, so almost 34 years of data we have taken. And this is the chart of the drawdowns. So from the peak, how much Sensex has come down. This is that chart. So if you look at maybe May 93, at this point, we saw a 50% correction here. Now, this is on a month end basis. During the month, it could have gone higher. It surely would have gone higher to maybe minus 55 or minus 60. But at the end of month, it ended at a 50% drawdown from the peak in March 92. That's what this chart represents. Now, if you look at a 10% correction over last 34 years, it has happened 13 times, right? And this is so an average of about 3 years. So which means every 3 years, what you are going to see is a 10% correction. Every 5 years, you're going to see a correction of about 20% or so, right? And every 10 years or so, you're going to see a correction of 40% or higher, right? So you can see there was one in May 93 where we saw more than 50, close to 50%. In around early 2002 is when we saw again more than 40% correction. In subprime crisis during 2008 is when we saw another correction. These are the three ones. We saw another correction in COVID, but here we are unable to see in this chart because during the month it recovered also most of the losses, and it ended at around 27-28% losses. But during the month, we saw, I think, more than 40%, somewhere around 40 to 45% correction. But at the end of the month, it was below 30. And that's why it's not getting reflected here. Right. So as you can see, corrections in equity markets are very normal. And they're very frequent, they're very normal, and you have to uh, go through it in order to realize the phenomenal returns that we see that equities have given over the years. Every 10 years, in spite of these corrections, every 10 years, you see Sensex has been tripling, right? And that is just a rate of 12% CAGR. So that's not a very high rate of growth. And that happens in spite of these corrections, right? So if you want to make money, you have to stay invested for long term. And it's not easy staying invested, going through all of these corrections, but it's good to look at what history has shown us that these corrections are very normal. Every few years, you get these kind of corrections. Every time the reason is different. You cannot really predict these reasons, but it's these corrections are very normal. So here, what I've taken is I've taken one of the longest bear markets. So it happened from August 94 to about August 1999. So more than 5 years, it is about 61 months when the markets were in drawdown. And as you can see, it's one of the longest. If you see the correction during COVID, it barely lasted not even 6 months actually. and within 6 months it was able to recover all of the losses. So it was a very, although very sharp correction, but it didn't last long, right? And that is why it didn't pain the investors, give pain to the investors as much as any other correction like this. For 5 years, uh, there was zero returns, or rather negative returns, if you invested in index, right? But let's look at what happened if you were consistent and if you were disciplined and doing your SIPs at the start of every month. Then exactly how did your returns look like? Okay, so for these 61 months from August 94 to August 99, you invested, let's say, 10,000 every month. So overall, your total investment amount was 6,10,000. And obviously, because the Sensex came down and just recovered, the Sensex returns were just 0%. You did not get any returns had you invested at the start of 94 till August of 99, right? But overall, because you were doing SIP, because you were investing at lower levels also, your overall portfolio value turned out to be 8,50,000 at the end of August 99. So a total gain of about 2,40,000 rupees, right? The total units that you would have purchased in Sensex would be 174 units. So average price would come out to be 3,514, right? Now let's look at how this happened. So this is the Sensex at the beginning of August 94. This was at slightly above 4,500. So maybe about 4,700 or so, somewhere around those levels. And for 5 years, it was just below that 4,500 levels, right? But you kept on investing every month 10,000 rupees. And finally, in August 99, it actually recovered to, it made a new high. So 5 years, only just one new high. But because you had been investing at these lower levels, your average price at which you had invested across these 5 years would have come out to be around 3,500, 3,500. That's what we have seen from our calculations, right? So overall, as I told you, your total gain, in spite of Sensex giving 0% returns for these 5 years, would have been 2,40,000 on an investment of 6 lakhs. So pretty decent gains. Definitely, I think these gains would be higher than FD levels. Right? But it's not easy. It's not easy because this is the chart of money invested versus your portfolio level, value at the end of 1 year. So during first 12 months, you would have invested about 1.2 lakhs, whereas your portfolio was below 1.2 lakhs. So you would have incurred a loss of about 10,850 rupees during first year. This is for the first 2 years. Again, as you can see, for the first 2 years, your profit or the portfolio value is roughly the similar. Sometimes it goes below, sometimes it's slightly higher, but it's similar to what you have invested. So roughly zero returns for 2 years. And this is the chart of money invested versus the portfolio value for the duration of 5 years. Now, if you see close to 5 years, your orange line, which is the portfolio value, is very close to the money invested. It's only towards the end when it had recovered and made a new high, that's when you will see most of the returns coming in, right? So for 5 years, you kept on investing and your portfolio value was similar to that of money invested. So you're not getting any returns at all. So that's why it's definitely not easy to keep investing in an asset class which hasn't been performing for some time. It tests your patience, it tests your discipline. But those who were able to uh, continue investing during these times would have finally uh, realized those gains. And this is during the bear markets. Obviously, after that, markets went pretty high, and your portfolio value would have uh, been much, much higher than the money invested over the next 5 years or so. Right. Now, let's say, now what is happening is during these times, a lot of people, what they're saying is, I want to stop uh, my new investments, my SIP investments, And when the markets recover a bit, that's the time when we will start our SIP. So let's say if you did the similar thing during these 5 years, so let's say you invested, you stopped your SIP whenever the market returns were lower than 20%. So if your market drawdowns are more than 20%, at that time you will not invest. Whereas if it is less than 20% losses, only then you will invest, right? If you did that, in that case, again, you would be investing the same amount. It's only that, let's say if you stopped your SIP for 2 months, and third month you invested. So in the third month, you will not be investing 10,000. You'll be also investing for prior 2 months. So overall 30,000 you'll end up investing. So you'll still invest over 61 months, 6 lakhs, 10,000 rupees. The Sensex returns would still be 0%, but your total portfolio value would be about 8.36 lakhs, which is still a gain of 2.26 lakhs. Right. But here the average price is closer to 3,900. Whereas in the earlier case, if you kept investing, your average price was lower. Average buying price was lower at 3,500 rupees. So this tells us that if you stop, the lower markets go, the better it is for long-term investors, because you will be able to enter at lower levels. Right. So this is the average buying price. The green one is the line, average buying price, which is closer to 3,900. If you stop your investments during when the drawdowns are more than 20%, whereas your buying price would be closer to 3,500 if you did not stop. So it makes all the sense that if the markets are making low, you really cannot tell for how long markets will keep going down, or till when it will make a new high. All of those questions nobody has an answer to. But one thing is clear, that somebody who is consistent, who is disciplined with SIP, will finally be in much better shape as compared to anyone else who is trying to time the markets. Right. So here, this is the final summary. A disciplined SIP versus an intelligent SIP, which means you're trying to time the market. Your total gain in the first case is 2,40,000, versus in second case, you still gain, but it is lower than what a simple approach can deliver. So overall, the bottom line here is SIP actually helps you average out the cost and smoothens the volatility of your overall portfolio. It is less emotionally taxing, because when you are trying to guess the market, when you are trying to time the market, you'll obviously feel very happy if you are correct. But if you are wrong, which you will be wrong many times, it will be really emotionally very taxing for you. And it is a very, very simple approach. You don't need to time the market. That means you don't need to spend any time figuring out, or in analysis, where the market could go next. So a very um, simple approach, which does not require any time, would perform much better than when you actually invest a lot of time in trying to figure out where the markets would go, right? So all in all, if the question in your mind is whether you should stop SIP, I think the answer is pretty clear. If you are a longer term investor, if you need the money in next 1, 2, 3 years, then the answer is not clear, obviously. But if you are a longer term investor, the answer is pretty clear that you should not stop. In fact, this is actually some of the best time to invest, because you are able to invest at much more lower levels, which is always good for you. Okay, I think that's it from my side. I'll now cover a few of the questions that we have got. And after that, I'll be happy to take any questions that people who are currently watching might have. So these are the questions we received. Dax Patel has asked us, Gulaq Gear 6 has underperformed compared to equity multi-cap. Where did we go wrong? So Dax, I really don't think, see, we have to differentiate between our process versus our results. So what we have seen historically, even in our back test or even in last 5 years, that it's not that if we underperform, we have done something wrong and we need to correct it. It's just the nature of our algorithms, is the nature of active investments, that whatever investment style you follow, if you are good, you might outperform the market, let's say 3 or 4 times out of 5, but there'll still be 1 or 2 years where you'll underperform, no matter what style, what equity style of investments you practice. So it's not that we did go wrong, we underperformed, but it's not that we did go wrong. We still believe that our portfolios, uh, as in the past we have performed, we have delivered, uh, we have outperformed the markets. We still are hopeful that the similar thing would happen. We would be outperforming, but obviously nothing is certain. But I don't think anything is wrong with our style of investing, just because for 1 year we have underperformed. My Gulaq Gear 6 has returned minus 10%. Do I still expect a positive return? So Anukumpa, I think I've already answered this. If you heard me uh, present that SIP investment analysis, I think it's the similar thing, that it has delivered. Overall, equity markets have only come down in the last 1 year, and Gulaq Gear 6 has slightly underperformed that. But over long run, if you continue a disciplined style of investing, not only in Gulaq Gear 6, but in any equity fund, that works much better than if you try to time these investments. So I would personally, I have invested quite decent money in our company's strategies, and over long run, I definitely expect positive returns. So Ishan is asking, your portfolio is rebalanced once every month. But I've noticed that there are stocks in Gulaq ASX that perform well mid-month and lose steam by the time of rebalancing. So we are missing out. Will it not be beneficial if the rebalancing is done as and when required? So Ishan, this is something that we have tested quite a lot. And in our analysis, whatever strategy or whatever rule we finalize, it has to add value over long run, right? So it might be the case that in last 3 months, had we been rebalancing as and when required, it might be beneficial. But over long run, would that strategy work well as compared to the current strategy? We do not believe so, right? Because we have to think, whatever we are doing, we have to think, if I keep doing it for longer term, would it add value or not? So the methodology that you are suggesting of rebalancing as and when required, this is something that we have tested exhaustively, but it really does not work as well as the current system. So we would much rather stick to the current system, even though it means slightly underperforming in the short run. But over long run, this is a better system than rebalancing as and when required. Okay. Avinish is asking, I'm doing a SIP in Gear 6 every month for the past year. I rebalance every time there's an update. What is the right way of rebalancing? Should I review updates? Is there a time to rebalance after the market opens? So, Avnish, I don't think there's a specific time. If you rebalance on the day, within 1 day or 2 days, I think you will do just fine. If the portfolio is not too large, in that case, you can rebalance any time of the day. Whereas if your portfolio is large, I would say 10 lakh plus is a large portfolio. If that is the case, then ideally you should rebalance, let's say from 9:30 to 10:30, that's the liquid hours, or 2:30 to 3:30 towards the end. Uh, that's when you should rebalance, because that's where most of the liquidity is, right? Second question you are asking is, should I review updates? Now you obviously have a option to review, because we are just advisors. At the end of the day, you are the one who is executing on that advice. But we wouldn't really advise that you review, because see, we are spending a lot of time on analyzing these stocks, analyzing each and every factor that is impacting these stocks or sectors or the overall economy, which I believe individual investors would not be able to add so much of value. So the best way forward for 99% of the investors would be to not review, and and execute as is. However, if you have a very strong view, and when I said 99%, I believe because I think we would be able to do better than more than 99% of the investors, retail investors out there. However, there might be 1% uh, of those investors who are very knowledgeable, who have that kind of skill set, who spend a lot of time researching, who might be able to outperform us. So if you believe you are in that 1%, then I would say that yes, do review and use your analysis. But otherwise, for the rest 99%, I would suggest to not review and accept as is. That would be my advice. कमल इज आस्किंग क्या ऐसा नहीं हो सकता कि फॉलिंग मार्केट्स में रीबैलेंस ना हो, कुछ टाइम होल्ड करके जब मार्केट स्टेबल हो जाए तब रीबैलेंस हो, हर बार रीबैलेंस की वजह से पास्ट 6 मंथ्स में लॉस हुआ है, प्लीज थिंक ओवर इट. सो कमल, दिस इज अगेन, वी हैव टेस्टेड, we have tried these things, and these kind of rules do not work over long run. That is something that you got to figure out. Every investment approach uh, will have a market where that approach would work very well, but then there will be few market regimes where your approach really wouldn't work, where you will underperform, right? So there is no clear cut answer. If you keep trying out a portfolio which is currently working, let's say Gulaq Gear 6 is not working right now, you exit, you invest in a portfolio which is currently working, you come back to Gulaq when it again starts working. I do not believe that works really well. Uh, that is again like timing the market, which is prone to a lot of errors. So I don't believe investors should do well. If you don't really like active style, where you will underperform from time to time, then the next thing that you can look at is the index funds, which will always give you the index returns, which will never underperform the market, but then they'll not outperform also. They'll always give you the index returns. But otherwise, if you look at active mutual funds or active portfolio like ours, uh, there's every chance every single one of them would be underperforming from time to time. So I think rebalance का point यही है कि these are some things we have tried. Currently, these things is not working, but over long run, this is a better approach. You've got to trust, you've got to have conviction on the methodology on our fund. That's what I have to say. Nilesh. So Nilesh is asking, last rebalance Gulaq Gear 6 for Gulaq Gear 6 was done on 1st April, new financial year, where some losses were booked. Appreciate if this could have been done before 31st March, since we could have gained by doing tax harvesting. Difficult to understand why a process and policy are so rigid and nothing can be changed, even if it's in the investor's interest. Okay. Yeah. So Nilesh, to an extent, I agree. I don't think we are rigid. If there is something like the suggestion from your side, uh, if this actually helps most of the investors and if most of the investors want it, I don't really think it will make a difference whether we rebalance on 1st versus 31st. It really won't create any difference at all. So we could have as well rebalanced on 31st of March as well. In this case, we did discuss, we didn't go ahead with it because there was not specific, not even, I don't think even a single specific demand from Gulaq investors to do so. And our understanding is also the same. The way I personally manage my portfolios and do tax harvesting is not fund wise, but overall portfolio wise. And that is, I think, a better approach which anyone who wants to do tax harvesting should follow, that do it on a portfolio level and not on a single fund level. That's a better approach. However, if many investors really want that we from our side do tax harvesting specifically in Gulaq Gear 6, we'll be happy to do so from next time. But as I told you, at least this time we did not receive even a single request to do so. and that's why we did not do. But we are definitely open. It's not that we are rigid. We are definitely more than happy to hear the suggestions that you or other investors have that can help us improve. So please do keep sharing your suggestions, and we'll be happy to look at if it adds value to everyone. Sumit is asking, sir, how are we better than mutual funds or ETFs when we buy and sell frequently in small case? Sometimes we exit a stock and then re-enter it. Why is that? So, Sumit, uh, now if we are running the same exact strategy in a mutual fund, then definitely I agree that mutual fund is a much better structure, even if exactly the same trades are replicated because of the tax advantageous nature of mutual funds. That within inside of mutual funds, whatever churning I am doing, investors are not liable to pay until unless they actually sell that mutual fund units and book the profits. Only then they are liable to pay any tax. Otherwise, no. In the current case, you are liable to pay it every year. So definitely, if the same strategy is being run in mutual funds, no doubt that mutual funds would be better. However, I haven't come across exactly same strategy. There are other quant mutual funds, but personally, I believe from whatever I have seen, whatever analysis I have done, I believe our fund methodology wise, performance wise is better than those other quant funds. But having said that, mutual funds, I personally also invest quite a lot in mutual funds, but they are not of similar nature. Their strategies are different, mostly discretionary. They are not quant mutual funds. In quant, I prefer Gear 6, investing in a Gear 6 portfolio. Yeah. Dhirendra is asking, Gulaq follows a multi-factor strategy, yet it hasn't shifted from momentum to value, like during the Russia-Ukraine war. Is this because of weak value signal or no? So Dhirendra, I have already showed. I'll just take you through that slide. Yeah. So as you can see, last 4 months in Feb we had some allocation to momentum. Otherwise, we are at this point of time last 3 months the maximum allocation, which is above 70%, is to value as a factor. So we currently most of the stocks that we have invested in is actually the undervalued stocks. So yeah, should we invest in bulk now since the market is falling? So Rishabh, I believe investing is a game of probabilities. It's a game of chance, right? You're never certain, right? So if the market has made a bottom and market start going up from here, in that case, the decision to invest in bulk would be the best decision, right? Because if markets keep on falling, then it is almost always advantageous that you stagger your investments. However, nobody knows markets kitna और नीचे जाएगा कितने time तक नीचे जाएगा, right? And emotionally, I feel to at least most of the investors that I've spoken to, emotionally for them, it is very hard for them to invest in bulk. For them, it is always easier to stagger their investments across 3 months or 6 months, and then go about doing it, right? So that's emotionally staggering your investments is a better choice. But if you just leave your emotions aside and just look at data, the market goes up roughly two-thirds of the time, and one-third of the time it comes down. So the probability is in your favor if you invest in bulk. So there's one thing that data tells us, that investing in bulk has better chances of success, whereas emotionally, if you see, SIP makes more sense. There's no clear answer, but that's what it is. So yeah, so now we are at the end. I've taken all the Q&A. Simran,
Yeah.
we now take any questions that we might have received.
Sure, Vivek. So, as we're starting with the live Q&A section now, so if you have any thoughts, questions, or even just want to say a hi, please drop a message in the chat and we would love to hear from you. So, the first question, is by Mr. Rajat Dunir. Hello, Simran and Vivek. Should we stop SIPs since markets are so volatile or increase the SIPs considering the markets have corrected so much? So I believe Vivek have already covered this section in the market correction portion. So Rajat, if you want, you can revise to that section and view the same. We would also be posting this video after the live ends in case you want to view it then. But stopping the SIP is not ideal if you're a long term investor. Short term dips don't necessarily mean long term losses. And we have seen this pattern play out in the history as well with the 2008 global financial crisis and the most recent COVID crash as well. So, the key takeaway is not to time the markets, but have a disciplined way of investing throughout and keeping regular with your SIPs. Vivek, would you like to add anything else?
No, I think that's it. And I think he asked if we can increase. So definitely, if you have money to invest, I would say definitely at these levels increase. If you are a longer term investor, no doubt about that, that you should increase.
So the next question is by Mr. Shiva. Hi, Gulaq. The SIPs are working for Sensex or Nifty Index Fund. How does SIPs in multi-factor models be beneficial since we are rebalancing every month on the best factors?
So it does not matter, frankly. See, even in Nifty or in Sensex or any other fund, what happens is inside that fund, churning is going on. There are companies who are getting included in the Sensex, and there are companies which are getting out of the Sensex every 6 months. Same happens with Nifty and with all the mutual funds also. Some of the mutual funds churn at a much more faster pace than these index. So inside the fund, there is churning going on. That happens everywhere. However, your investments, the money that you are putting in overall equity markets, that's what counts, right? So these SIPs would always work whether you are churning or not. They'll always work, right?
The next question is by Mr. AK. Factor based investing is getting very popular. More than 20,000 crores is invested in passive smart beta funds alone. Do you think factor based strategies would hold its potential in the long run?
In the long run, see, in the medium to short run, definitely they would work because I do not believe there is uh, enough competition in this. So for the ones who are doing it well, it makes their job easier, right? If there are a lot of fund managers who are using factor investing, lot of good fund managers who are using factor investing to construct their portfolios, then it will be definitely tougher. But I do not see that in the near future. I think 10 years down the line, I see a lot of very good fund managers in this space. And then definitely it will make our job harder, but definitely not in the short to medium run, let's say next 2 to 5 years. I think there's enough opportunity out there for everyone who is practicing this quant investing or factor investing.
So the next question is again by Mr. AK. Markets often overreact. Big drops, sharp rebounds, like during the budget and again today with Nifty up 1.7%. Most volumes come from the FLS. Is this really smart money?
So typically, what is said is that retail investor or money that is coming in from retail is the dumb money, and the money that is coming in from financial institutions is the smart money. Um, I don't know. I've seen enough dumb institutional investors also, and I've seen many smart retail investors also, frankly. I think the biggest point here is controlling your emotions. It's not definitely not about the methodology. Uh, Factor investing might sound very smart. It might sound very complex also. But at the end of the day, the people who are investing in any fund, be it a factor fund or be it a normal index fund, if they cannot control their emotions, they'll always lose out to the other set of people who can control their emotions. So currently, as we talked about, there are a lot of people who are stopping SIP, who are fearful, who are also redeeming. I spoke to a couple of investors who redeemed at just before this 6-7% up move that we saw last month. So we don't know, frankly, whether the markets would go up or down. Uh, but what I have seen in my experience, most of the people who try to time the market, who take decisions on the basis of emotions, whether it's greed or fear, they tend to lose out over the long run. That's what I have to say. I really, frankly, don't know about smart or dumb money, but people who keep emotions aside are the ones who would really succeed in the long run.
I hope that answers your question, Mr. AK. Next question is by Mr. Shiva. As an investor in Gulaq Year 6, what should I be aware from Trump tariff trade war?
See, Shiva, I think that's the beauty of investing with a fund manager like us or even mutual funds. Uh, that you don't need to do that hard work. Our team is looking at what is going on, how does it impact the multiple sectors, the economy, all of those things. Our team is doing the analysis, or any fund manager, be it HDFC, be it Parag Parekh, that's the job of the fund manager. And that's what I see. A lot of the noise in the news, in social media, it's about what to do with a specific stock. How do you select your sector that you need to be invested in, which stock it impacts positively, negatively, all of these things. I think more than 80 to 90% of the investors, they would do well to just leave these decisions to the fund manager. There are very, very few investors who have that kind of skill set to actually make good decisions at a stock level, right? Because here we have a big team who is actually doing this task on your behalf, and that's what you are paying us for. So as investors, I really believe that most of the investors would do well if they don't get into these kind of details and leave those kind of decisions to the fund manager that they are investing in. If you do not trust us as a fund manager, maybe go to HDFC or whatever a fund that you trust. But the point I'm making is leave these kind of decisions to the fund manager. It'll really help your portfolio and make your life easier.
Right, Vivek. I mean, it's always good to be informed about everything, but ultimately, if you are trusting a manager, you should leave the decisions up to them. We are here to make your life simpler and not complicate it even
Yeah.
further.
See, if the broader decisions, you should. I don't see a lot of discussion about asset allocation. How much should be invested in equity, uh, depending on your risk profile, depending on your goals. Those are, I think, much bigger decisions rather than these kind of decisions. So those are the kind of decisions or that investors should think about much more, that how much I need to invest to achieve my goals, how much in each asset class. After that, whether it goes to IT sector or goes to metals or banking, or which stock in these sectors should be left to the fund manager to do, to take those kind of decisions.
Sure, Vivek. The next question is by Mr. EK again. Your I alpha net returns are about 11%, which is very close to Nifty long-term returns. How can one invest in that? How scalable is that strategy?
So, AK, if see, you can actually get in touch with our support team. We'll be happy to take you through that I-alpha strategy, where returns have been net about 11%. You will be happy. That's a PMS structure in which the minimum ticket size is 50 lakhs. So we'll be happy to share those details. Please get in touch with our support team, and we'll definitely take you through whole investing process. That's a decently scalable strategy, uh, which which has a unique track record of never ever having even a single negative month in past 16, 17 years that it has been running.
So you can reach out to pms.stadvisors.com or support.gulaq.com for getting in touch with us. The next question is, many financial pundits spoke negatively on India's macro during the Jan Feb fall, then turned positive in March amid some recovery. Now there's pessimism again. Feels bizarre to me. What's your view?
See, I am very, very positive over long term on India's potential, right? Uh, the way these things happens is if the markets, this is just the result of what is happening in the market. I do not believe that from month to month the prospects of a country changes so fast, right? It is just that if the markets are going up, they'll try to find out all the positive reasons why it's going up, and when the markets are coming down, they try to find all the negative reasons why it makes sense that these markets are coming down. They'll justify it after the move has happened. It's never before, it's always after. That today markets fell 3%, what was the reason? Today it went up 1.5%, what was the reason? It's always post the move that this kind of analysis, it doesn't help anyone, frankly. This kind of analysis on a daily basis or even a monthly basis, this does not help anyone. Over long run, I'm very, very bullish on Indian markets, Indian economy. I think we'll do very well. But only those investors would be able to do well who are able to keep their emotions aside when we have both bear markets or even bullish markets. What happens in bullish markets is you tend to become very anxious and you want to book your profits and want to get out. That's another mistake that we make on the other side when the markets are really booming. I think if you can just stay invested uh, over longer run without trying to time the markets, just those simple boring things, if one can do, they'll do very well over long.
So, I would urge the audience if they have any more questions, because currently this was the last question that we had. So, we'll just wait for a couple of more minutes in case you want to hit us with another question. Even if you have any feedback for us, how we can improve, or any other kind of solutions that you're looking from us, do post it in the chat so that we can take it internally and get back to you on the same. Okay, Vivek, there are no more questions coming in, so now would be a good time to end this session. Thank you so much for your time, and thank you everyone for joining. Have a good night, and we will see you next month.
Thank you, Simran. Thank you, everyone. Bye.